Good afternoon, everybody. Uneducated Economist here. So oftentimes when I hear people talking about the Federal Reserve and the monetary policy, they focus in on the Fed funds rate, which is the interest rate setting policy that comes from the Federal Reserve. Now, typically when you hear about the Federal Reserve adjusting interest rates, they're usually trying to either stimulate the economy or try to restrict the economic activity that is happening out there. And by adjusting the interest rates that people are paying when they take out a loan, really shows a lot of what kind of commerce is taking place within the economy. If you have low interest rates, generally you see a booming housing market, you see auto sales doing well, you'll find that the stock market, bond market, all these things have a tendency to do quite well when you're looking at the prices during a time of economic stimulus that's coming from the Federal Reserve and the low interest rates. Now that we have interest rates elevated, it's quite the opposite. You would expect that the markets would come down, that the housing market would come down, that the financial market would be, in more of distress than it is today. Now, although you do see a lot of issues taking place within the banking industry, especially with the downgrades that are happening, not only to the U.S. Treasuries, but to a lot of banks that are out there as well, facing these downgrades, which then in turn has issues within the credit ratings of these big institutions. And then in turn from that, those issues that these big institutions are facing then means that they are taking on risk by loaning out money. So then the lending standards start to increase. And this in itself has a restriction to the economy. And now that's really where I start to focus in, is that those lending standards that are out there. Like, this isn't something that a lot of people really talk about. And how when the Federal Reserve raises interest rates, right, when they lift the interest rates and try to restrict the economy, not always do they mess with the regulations within the banking industry, like allowing the, say, credit ratings for home loans to exist at a particular level, which may be more accommodative than they should be. And I mean, I don't know quite if that explains it quite clearly, but even though they have interest rates elevated, they still might make the lending standards so easy to get that even though the interest rates are elevated, people who typically would not be qualified for a loan are getting loans because those regulations are so lenient. Now what we're going to start finding is that the Federal Reserve may keep interest rates at their level, like not adjust them at all, but then still be able to restrict the economy by adjusting the regulations that are, or the lending standards that are out there for getting a loan. So you may find today that you may qualify for a loan at these particular interest rates, but as time goes on, we may find that the credit standards or the lending standards start to become more restrictive, which then in turn starts putting, a downturn on the economy. And this is, essentially what the Federal Reserve is looking for. So that's something that I would be paying attention to, is the banking regulations and how they might become more stringent coming into the future. Like, you might think, okay, I can handle these interest rates, but then you may not qualify for the loan, considering, what's coming into the future as far as those regulations go. Now, something else that I really kind of wanted to focus in on, when you think about like where these interest rates are headed and how it is that it impacts the economy in a way that is not necessarily what everybody would anticipate. Because a lot of people, let me see if I got this right. When you think about like the Fed funds and the lower interest rates, most people think lower interest rates means that the economy is going to be going fast, right? And that a lot of people will be taking out loans and the housing market booms and all this economic activity happens when the interest rates fall. Right? And then as the interest rates rise, the exact opposite happens. But this is coming from the Federal Reserve and their monetary policy. See, like, they're pushing interest rates low and they're making interest rates restrictive, right? This is their attempt. But if the Federal Reserve wasn't involved with the interest rates, they would not be acting in the same fashion during times of economic booms and downturns, right? So now, typically, if there was a, say, pre-Federal Reserve existence, right? We go back in history, we're on a gold standard, there's a commodity-based currency happening here with gold, right? And there's a limited amount of it. And you have an economy that starts heating up, right? All of a sudden, there's a lot of economic activity. There's people doing a lot of transactions. And there's people out there, some entrepreneurs, who want to borrow money to participate in this economy, now that things are heating up and being quite active. Now, what you find during these particular times is that the interest rates would start moving up, right? As the people who are looking to borrow money become more prevalent out there in the economy, like a supply and demand issue, right? So if you have more people who are in demand of money, the people who are offering up money are going to be asking for more return, right? So again, like if I am the supplier and there's a huge demand out there, well then if I'm a supplier, I'm going to get a bigger return off of it the bigger the demand is, right? So this is typically when you would see interest rates rise, is during a time in which that the economy is heating up and there's more economic activity happening out there. See, this is really when you would see interest rates rise. Now, when the interest rates would fall, again, this is, back prior to the Federal Reserve and all the central banking activity, right? When you see interest rates fall, well, that would mean that there was less economic activity happening out there. And the people who want to lend money to try and get a return on their capital would then have trouble finding people to borrow money, right? There's less entrepreneurs out there looking to participate in the economy. And so they would have to offer up a lesser interest rate in order to lend that money out there. You see, again, it's like a supply and demand thing. We don't find that in existence in today's economy. Because of the Federal Reserve and the central bank's money manipulation and interest rate setting policies, they can then take a hot economy when interest rates would typically be elevated, and they can restrict that economy by increasing interest rates even more. You see what's happened here? It's like they have the economy completely flipped backwards on the way that the interest rates should be set. Right? The free market should be setting interest rates according to the demand of money that is existing in there at the time. But the Federal Reserve can adjust the demand of money by interest rate setting policy. See, it's not working the same way anymore. The economy used to dictate how much money would exist, right? Or the demand for money exist and the interest rates that was set with it. But now the Federal Reserve does that and makes the economy adjust to the interest rate setting policy. And so this is the reason why a lot of things are backwards from the way that people would normally anticipate the economy functioning, right? When the Federal Reserve is in the middle of manipulating interest rates, pretty soon the economy doesn't behave in the way that it should, or in the way that would be intuitive to what most people would think, right? And so all of a sudden we have economic activity that becomes very obscured in its clarity, right? It becomes very difficult to see how it is that the Federal Reserve is conducting their strategy, when most of the time you're thinking that the Federal Reserve had screwed up. See, they never screwed up. This is the way that they understand the economy in a fashion that is much different from what everybody else is thinking. When they see that the Federal Reserve is lowering interest rates, they think hot economy. Right? And when they see the interest rates go up, they think slow economy, right? Cold economy. It's better to think about it hot and cold, right? Or fast and slow. That's easier rather than good or bad, because, whether it's a good or bad economy depends on how you positioned yourself for it. But really, this is how the Federal Reserve has really been able to conduct their monetary policy in a way that then has the people very focused in on the Fed funds level, on the financial markets, on everything that is out there that is involved with the banking system. But really, it's the true economy, the decisions that we make, for ourselves, for the businesses we start, the investments that we make. See, we the people are the real economy, not the Federal Reserve. But everybody focuses in on the Federal Reserve as if they're the economy. That's not the case. The Federal Reserve is interacting with the economy and has the people believing that their interest rate setting policy then dictates where the economy is going to be and how well it functions. It doesn't quite work that way. All right, I'm going to leave it at that. Uneducated Economist, you guys let me know.